compound curse, from dream to debt spiral. Welcome to this exploration into something that's probably touched all our lives in one way or another, the world of borrowing for big needs like a home, and how it can spiral into something much bigger than we expect. Picture this, you're just trying to get a roof over your head, a simple place to call your own, but the way money works today can turn that basic dream into a lifelong chase. We're going to unpack how credit gets created out of thin air, how interest piles on, and why compound interest can feel like quicksand. Stick with me as we explore this through a real-world example of buying a modest house. Before we continue exploring the intricacies of this subject, I'd like to pause for a moment to say, if something in our discussion strikes a chord, whether it's a compelling historical detail or a fresh perspective, please take a second to like and share this episode, and make sure to follow or subscribe for more in-depth conversations ahead. Your support truly matters and helps us keep bringing you engaging explorations like this one. Let's start by painting a picture without getting into the gritty details just yet. Imagine someone earning a steady wage, say from a regular job, but after all the essentials like taxes, food, and bills, they've got a bit left over each month. They spot a small house or apartment that's affordable on paper, nothing fancy, just enough for a fresh start. They take out a loan because, hey, who has that kind of cash up front? The bank says sure, and suddenly there's money in the system that wasn't there before. But here's the hook. That loan comes with a price tag that grows over time, and if it's not handled right, that monthly leftover cash might not even touch the core amount owed. It starts feeding on itself, pulling you deeper. It's like planting a seed that grows into a vine wrapping around your finances, all from wanting something as basic as shelter. We'll see how this plays out soon. Alright, now let's roll up our sleeves and look at the full story. Take this person working 40 hours a week at $25 an hour, that's $1,000 gross per week, or about $4,333 a month on average. But life hits hard. Taxes, insurance, food, rent, or whatever until they buy clothes, all that stuff eats up most of it, leaving just $5 per hour left over, which shakes out to $200 a week or roughly $867 a month they can actually use for extras like debt payments. Now, they find a small house in a place like McAllen, Texas, where prices are reasonable, median around $268,000, but you can snag a starter home or condo for $175,000. It's modest, maybe 1,200 square feet, a couple bedrooms, nothing extravagant. They get a mortgage at 6% APR, which is right in line with today's averages for a 30-year fixed, around 6.09% as per recent reports from sources like Freddie Mac. The bank approves the loan, and here's where the magic happens. That $175,000 doesn't come from some vault of existing cash. In our modern banking setup, when the bank issues that mortgage, they essentially create that money right then and there. It's not like they're dipping into a pool of deposits from other folks and handing it over. No, through what's called fractional reserve banking, banks hold back only a small slice of reserves, historically around 10%, though that's evolved, and lend out the rest, but really, the loan itself generates new money in the economy. Think about it. You sign the papers, the bank credits the seller's account with $175,000, and poof, that's fresh currency circulating. But you owe it back plus more. That more is interest, calculated monthly at 0.5%. 6% divided by 12. For a loan like this, the interest alone starts at about $875 a month, already edging out that $867 left over. So, even putting every spare dollar toward it, you're barely covering the interest, and the principal sticks around. Over time, since the interest isn't fully paid, it compounds, meaning unpaid interest gets added to the principal, and future interest is charged on that bigger amount. In year one, with $867 monthly payments totaling about $10,400 annually, the balance creeps up to $175,103 because the interest charged is $10,503. Year 2. Interest hits $10,509, balance to $175,212. It keeps climbing, year 5 to $175,581. Year 10 to $176,365. Despite pouring in over $104,000 in payments by year 10, the debt's grown by more than $1,365, and it's not stopping. That simple need for a house has locked them into a cycle where the debt never shrinks. It just swells forever, demanding more and more from that fixed leftover income. Now, let's dig into the bigger picture here, the themes behind why this happens and what it means. At its core, this ties back to how our money system is built around debt. Banks don't just move money around, they create it when they lend. Back in ancient times, like with the Code of Hammurabi around 1750 BC, there were rules capping interest on loans, often in grain or silver, to keep things fair. But as societies grew, lending evolved. Aristotle, way back in the 4th century BC, slammed charging interest as unnatural, saying money shouldn't breed money. It's meant to facilitate trade, not multiply on its own. That view echoed through history. In the Middle Ages, major religions like Christianity and Islam outright banned usury, which meant any interest at all, seeing it as exploiting the needy. The Bible has passages against it, like in Exodus forbidding interest on loans to the poor, and the Quran calls it a grave sin. Even in early England under Henry VIII, usury started as any interest but got capped at 10% to curb excesses. But over centuries, as trade boomed in Europe, those bans softened. Long-distance commerce needed credit, and by the 18th century, laws like England's Statute of and reduced caps further. In the early U.S. colonies, usury laws were strict. Massachusetts in the 1700s set 6% max, with penalties like forfeiting the whole loan if you charged more. Ideas shifted. Economists argued free markets and money could boost growth, and states competed for capital by easing rules. By the 1800s, many repealed or liberalized them, though never fully ditched. Today, that legacy means banks can create money via loans, but the interest they charge isn't created alongside it. For every dollar loaned into existence, there's interest owed on top, but no extra money made to pay that interest. It forces constant economic expansion, more borrowing, more growth, to generate the funds to cover it. Without that, defaults rise and the system wobbles. In this house scenario, that's the trap. The interest demands more than what's available from income, so the debt compounds. Compound interest is ruthless. It's interest on interest, exponential growth. Einstein supposedly called it the eighth wonder of the world. But on the debt side, it's a nightmare. If you only pay enough to skim the surface, like our example, the balance balloons. Broader debt traps amplify this. High-interest loans like payday ones at 25 to 45% APR suck people in for quick cash but compound into cycles where you borrow more to pay the old. For homes, it's subtler. Mortgages seem low-rate, but if your loan's too big relative to disposable income, you're stuck. Unexpected hits like job loss or rate hikes, though fixed here, worsen it. The system incentivizes this. Banks profit from the interest, creating money but claiming a cut that outpaces what's produced. Concentrates wealth. Lenders get richer while borrowers chase payments. Historically, this led to debt forgiveness like biblical jubilees every 50 years, wiping slates clean to prevent societal collapse. Without that, inequality festers, pushing endless growth that strains resources. Pulling from those roots, here are some timeless words that capture the essence. Aristotle put it bluntly. The most hated sort, and with the greatest reason, is usury, which makes a gain out of money itself, and not from the natural object of it. For money was intended to be used in exchange, but not to increase at interest. From the Quran. Those who devour usury will not stand except as stand one whom the evil one by his touch hath driven to madness. In Deuteronomy. Thou shalt not lend upon usury to thy brother. Usury of money, usury of victuals, usury of anything that is lent upon usury. And from medieval church decrees, like the Council of Lyons in 1274. Usury is detestable to God and man, and is forbidden by divine and human laws. These highlight how interest was seen as exploitative, breeding inequality without real work. Wrapping this up, if you're eyeing that house or any big borrow, crunch the numbers hard. Ensure your disposable cash covers interest plus some principal. Shop rates. Aim for shorter terms if possible to cut total interest. Build an emergency fund to avoid compounding surprises. And think bigger. In a free market, transparency and competition can help, but question systems that create money tied to debt. Maybe push for reforms like lower caps on rates or education on these traps. It's empowering to know how it works so you don't fall in. Thanks for joining me on this journey. Catch you next time with more on navigating life's financial twists. Stay debt-free, stay free.